Forgetting in nothing is blessing to see.
In our last class, we discussed all the underlying concepts of business valuation. We discussed how to use asset-based approach to value a business. We discussed income-based approach, and finally, discounted cash flow-based method of valuation. Under the discounted cash flow basis. We talk about scenario 1. We said scenario 1 is a situation whereby business and financial risk of a company are expected to change as a result of undertaking a project. When this happens, the free cash flows of the combined businesses will be discounted using WACOB, that is, WACC of the combined businesses. That is when business and financial risk will change. We'll talk about scenario 2. We say scenario 2 is a situation whereby business risk will not change, but financial risk will change as a result of the business combination. Under scenario 2, you are expected to value the business using the adjusted present value. Same procedure that you normally carried out under adjusted present value are what you are expected to also carry out. Scenario 3, we said it will occur. Scenario 3 will occur where business and financial risk will remain constant. It will not change due to the business combination. So when that happens, the most important thing to do is to value the transaction using the existing WACC of the combined businesses. So these are the scenarios we discussed in our last class. Not only that, I also explained to you how to identify whether business risk will change as well as the financial risk. I said, if in the question you are told that the two companies are in different industry, provided the two combined businesses are in different industries, then it means that business risk is going to change, because business risk is the risk associated with the industry where a company operates. That is on one side. On the other hand, if you want to ascertain whether business risk will change, if in the question you are given different asset beta for each company, okay? You are given different asset beta for the combined businesses. You remember, asset beta measures only business risk. So provided you are given a different asset beta, it means that business risk will change. But if you are given the same asset beta for the two companies, it means that business risk will not change. That is how to identify whether business risk will change or not. On the flip side, the financial risk, we said, is the risk arising from debt financing. When a company finances operation with debt capital, like bond, debenture, loan note, or bank loan, then financial risk will change. A company will be exposed to financial risk. So in relation to valuation, we say financial risk will change if the business combination will involve paying debts. If the targeting company is going to pay debts as a result of the business combination through merger or acquisition, then it means that financial risk will change. But if the business combination will not involve any debt payments, it means that financial risk will not change. Another way you can know whether financial risk will change is the fact that if you are given debt equity proportion after the business combination, that is for the combined businesses, you are given debt equity proportion after the acquisition or after the merger, then it means that financial risk will change. So other than all of this, financial risk will remain constant, okay? So these are the things you need to take into consideration before you put your pen to paper. But one thing is very common, as far as the discounted cash flow method is concerned, you are going to need free cash flow. You are going to calculate free cash flow. In our last class online, we have done calculations using asset-based approach as well as the income-based approach. So today, let's try I have planned to solve minimum of 4 illustrations, but how I'm going to achieve that, I don't know. But that notwithstanding, so I will take my time to explain. Let's have the illustrations on the 3 scenarios. Once we are done with that, then we can add any other scenario-based question. Okay, so please, while you are in the class, always mute yourself. Always mute yourself. If you want to ask a question, please just raise your hand. All right? Okay, then. So let's start with illustration number 6. Open to your material where you are. Let's start with illustration number 6. So as usual, sorry, this is not it. Let me see. This is okay. So open to illustration number 5 in your material. All right. Let's go through the question together. Eco PLC is a producer of a variety of vegetable oil and other fresh and other household products in Lagos. The company presently faces a significant competition in the market of its major raw materials, palm oil. To secure regular flow of raw material, the directors of EP PLC are now considering making an offer for the entire share capital of Benin Oil PLC, a palm oil producing company in Benin. Okay, so a company is making an offer, all right, making an offer for the entire share capital. That means this is acquisition. Okay, this is acquisition. All right. The following financial information is provided for the 2 companies. We are given asset beta, equity beta, number of shares in million, then current share price. It is thought that combining the 2 companies will result in several benefits. It is estimated that combining the 2 companies will generate free cash flow to the firm of 1.1 billion, okay, 1.1 billion in current value terms. You can see all those things we normally talk about under capital budgeting also applies there. So we are told that there is a free cash flow to the firm of 1 billion and 80 million naira in current value terms. What it simply means is that you need to start inflating from year 1 because your free cash flow is in current value terms. Inflation should start from year 1. But this will increase by an annual growth rate of 5%. Here I can see the growth rates. The growth rate is just like the inflation rates. Okay. So the growth rate is 5%. For the next 4 years, pay attention to that. Before reverting to an annual growth rate of 2.25 in perpetuity. The first 4 years represent the planning stage of the business combination. That's the initial stage. So after the planning stage to infinity, then that will be the second phase of the business combination. And you are now told that the growth rate after the 4 years, after year 4 is 2.25 in perpetuity. In addition to this, combining the company will result in cash synergy of a benefit of 100 million naira per year. Okay, that's 100 million for the next 4 years. These synergy benefits are not subject to any inflationary increase, and no synergy benefit will occur after the 4th year. So this simply means that even though your free cash flow to the firm will increase year on year by 5%, however, the synergy benefit of 100 million naira will not increase. It is constant. And also, there is no synergy after year 4. Okay? The debt to equity ratio of the combined company will be 40% before tax. So examiner has given us debt equity proportion of the combined business, okay, after the combination, after the business combination. All right, you're also given the cost of debt to be 4.5%. That's your KD. Your KD is 4.5, 4.55. Watch out. The income tax rate is 20%. Okay, let's indicate that. Tax. The current risk-free rate of return is 2%, and the market risk premium is 7%. It can be assumed that the combined company's asset beta is the weighted average of EP PLCs and BO PLCs asset beta weighted by their current market value. Okay. EP PLC has offered to acquire BO PLC through a mixed offer of one of its shares for 2 BO PLC shares plus a cash payment such that a 30% premium is paid for the acquisition. Shareholders of BO PLC feel that a 50% premium would be more acceptable. EP PLC has sufficient cash reserves if the premium is 30%, but not if it is 50%. Only you are required to estimate the additional equity value created by combining EP and BO PLC based on the free cash flow to the firm method. Comment on the result obtained and discuss briefly the assumption made. B, estimate the impact of the EP PLC equity holders. If premium paid is increased to 50% from 30%, then C, estimate the additional funds required if a premium of 50% is paid instead of 30%, and discuss how this premium could be financed. All right, so that is the question. That is the question. So what are you supposed to do? First thing first, irrespective of the scenarios in the business combination, the first thing you need to do is to calculate free cash flow. And examiner has made life so easy for you by giving you the free cash flow itself to be 1.1 billion, that is 1,080 million. So without wasting more time, let me stop sharing this and move to the working notes. Open to the question at your own hand so that we can follow through together. Okay. All right. So let's calculate. The first thing we are going to do is to calculate free cash flow to the firm. Solution to illustration number 5. A co-PLC is the name of the predator, the targeting company. Then number A, examiner is asking you to estimate the additional equity value created. The additional equity value created will be the difference between the post-acquisition market value and the pre-acquisition market value of the combined businesses. So there is no way you are going to get the additional equity value created without first of all determining the post-acquisition market value. So you are going to first calculate the post-acquisition market value and then the pre-acquisition market value of the combined businesses. Then you now find the difference. However, as far as this question is concerned, what we are going to do is to first of all calculate the free cash flow. Once we have calculated the free cash flow, then we now go back to the question to go and ascertain which scenario. Is it scenario 1 or scenario 2? So because the scenario will tell you which cost of capital you need to use to discount your free cash flow. That is very important. All right. So the first thing we are going to do now is to calculate free cash flow. So just keep it on one side. So calculating free cash flow to the firm. Figures are in million. Okay. So examiner asks us to do for the next 4 years. So when you want to calculate free cash flow, you don't include year 0. So I have year 1, year 2, year 3, then year 4. Okay. So I would then say free cash flow to the firm. Examiner has made life easy for us by giving us free cash flow to the firm of 1,080. We're now told that that free cash flow will grow by 5% for the next 4 years. 5% for the next 4 years. Let me adjust this. Year 1, 2, 3, then 4. Okay. Now, the free cash flow given to us in the question is in current value terms. So inflation should start from year 1. You should start growing the free cash flow from year 1. So bring out your calculator. Let's do that together. 1080 multiplied by 1.05. That's 1134 for year 1. 1134 multiplied by 1.05 equal 1191 multiplied by 1.05, 1250 multiplied by 1.05 equal 13. So with this, I've grown the free cash flow to the firm. The next thing I need to do is to now discount. So for me to be able to get my market value, sorry, this heading is supposed to be market value first. This is market value. So for me to be able to get the market value, I will need to discount the free cash flow at the appropriate cost of capital. Therefore, I will say discount factor at, I don't know. So we need to go back to the question. And before that, examiner also told us that there's a synergy. Okay, there's a synergy of 100 million for each year. We are told that this synergy will not be impacted with any growth rates. So there's no growth in synergy and there's no synergy after year 4. So in that case, our net cash flow will then be 1, 2, 3, 4. 1, 2, 9, 1. 1, 3, 5, 0. Then 1, 4, 1, 3. That's our net cash flow. Then we need to discount this net cash flow at the appropriate cost of capital. So discount factor at, I don't know. So let's go and calculate it. So let's go back to the question. Now that we have determined our net cash flow, the next thing we need to do is to ascertain the scenario, the kind of scenario we have in the question, whether it is scenario 1, scenario 2, or scenario 3. So first thing first, we need to ascertain whether business trees will change. So we then go back to the question. From the first paragraph, let's check if we have any indication to show that the two businesses are in the same industry or in different industry. We are told that Eco PLC Eco Products PLC is a producer of a variety of vegetable oil and other household products in Lagos. So that's one. Eco PLC is into production of vegetable oil and other household products in Lagos. Then we are now given Bini oil. Okay. We are told that the company is trying to make an offer for the entire share capital of Benin Oil, BOPLC, a palm oil producing company in Benin. You can see Eco PLC is into production of vegetable oil and other household items, but Benin Oil is into palm oil producing. Vegetable oil, palm oil, is it not the same thing? Is it is the same? You cannot differentiate. It's not clear with that information in that paragraph. It's not clear whether the two of them are in the same industry or not, because vegetable oil, palm oil is almost the same thing. They are in the same industry, if I want to take it that way. Except that, of course, we can say that vegetable oil is different from palm oil. But that notwithstanding, you can also say that, okay, Toyota motor vehicle and Honda motor vehicle, are they not in the same industry? Because vehicle is vehicle, oil is oil. But again, like I said, in this first paragraph, there is no clear indication to know that the two businesses and whether they are in the same industry or in different industry. So we cannot use that basis to identify whether business tree will change. So let's move on from the question. You can see from the data given to you, from this statistic, you are given equity beta of 1.2 for each of the business. You know that equity beta measure both business and financial risk. So that is not what we are looking for. Let's check asset beta, because asset beta measures only business risk. So once the asset betas are different, it means that the two businesses are in different industry. But if you are given the same asset beta for the two businesses, it means they are in the same industry. So as you can see, the asset beta given to us in this question are different. It means that both EP and BOPLC are in different industry, which means that business risk will change, financial risk will also change. All right. So that is that. Let me see if I can write it down somewhere. This will be for the first, second, let's maybe add another one. So then working will be here. Okay. Working number one. So I would say since business risk, since we don't have time for all of this story. Since asset beta of the two companies since asset beta of EP and BO are different, it means business risk will change. That's on one side. Let's go and check from the question whether financial risk will change. Okay. Now, and I told you that financial risk will change if the business combination will involve paying debts. If EPPLC is going to pay debts as a result of the business, as a result of the acquisition, then it means that financial risk will change. That is one. Then two, another way you can identify whether financial risk will change is if you are given debt equity proportion after the business combination, then it means that financial risk will change. When I was reading it, I think I noted it somewhere. Okay, examiner told us that the debt equity proportion will be 40 to 60. Yes, in the paragraph after the figures given to us, almost the last sentence there. You are told that the debt to equity ratio of the combined company will be 40 to 60 in market value terms, and it is expected that the combined company's cost of debt will be 4.55% before tax. So examiner has given to us the debt equity ratio after the business combination. It means that financial risk will change. Okay, so I will say debt equity proportion, debt equity ratio of 40 to 60 is given for the combined companies. This means, as a result, financial risk will change. Okay, so financial risk will change, business risk will also change. It means we should discount the free cash flow using WACOB. Therefore, the free cash flow to the firm will be discounted using WACOB. Since business risk and financial risk will change. Okay, so if that is the case, we need to calculate WACOB. So I will then say calculating WACOB, WACC of the combined businesses. In calculating WACOB, we said there are 7 procedures. The first procedure to calculating WACOB is to identify the beta of individual company. So there's no need for you to say identify, just say beta of each company. The first company is EP. I will then go to the question. What is the beta of EP? Okay, the beta of EP, asset beta is 0.9. There is no need for, you don't need equity beta. What you need is asset beta. So 0.9 for EP, for BO is equal to 1.2. Step 2 is to ungear. Let me rewrite this one to be asset beta because we are using asset beta. Assets beta of each company. Okay. Then we need to ungear. Remember, you only ungear if the beta in step 1 is geared. We are given asset beta for each of the companies. Asset beta is an ungeared beta. Therefore, you are going to ignore step 2. Okay? So no need to ungear since asset beta is given. But if you are given equity beta, so it's a different ball game. Then step 3. Step 3 says you should calculate market value of equity and debts of each businesses. So market value. This market value will then be the pre-acquisition. So calculate pre-acquisition market value. Pre-acquisition acquisition, market value of equity and debts. That's step 3. Okay, so first thing first, you need to calculate market value of equity. So market value of equity denoted as E. I will then go to the question, how am I going to calculate market value of equity? Examiner has given us number of shares. You're also given current share price. So you need nobody to tell you that market value of equity will be computed as number of shares multiplied by XDIV share price. Okay, multiplied by share price. Therefore, I will calculate for each of the companies. The first company is EP. Market value of EP. I will then go there. Number of share of EP is 210 million. Here is 210 million shares. Multiplied by the share price of EP, which is 29 naira. Okay, so equal 210 multiplied by 29 equal 6090. Here is 6090. Figures in million. That's the market value of equity of EP. I will do the same thing for BO. The number of shares of BO is 200 million. Share price is 12 naira. So 200 million shares multiplied by 12 naira. That's 2,400. So total value of equity will then be equal to 8490. So that is the market value, total market value of equity total market value of equity of EP and then BO. That is for that. Then let's go to the question if we can have information on debts. So based on the data given, we don't have any information, the market value of the debts, whether the venture, loan note, or bonds. So we are not given all of that.
Ratio.
Which ratio? Which ratio?
I'm looking at it. They gave us a debt to equity ratio of the combined company.
The ratio of 40 to 60 is after the acquisition. We are calculating market value before the acquisition.
Before, okay.
Okay. All right. So we don't have information on the debt. Therefore, there's no need for you to calculate the pre-acquisition market value of the debt. In case you are given, so all you need to do, you know how to calculate the value of debt, which is nominal value multiplied by X int price divided by 100. So you get the value of the debt. So it's the same thing as what we have done previously under cost of capital. So step 4. Step 4 says you should calculate the weighted average of asset beta. Okay, calculate weighted average asset beta. Sorry, I did not put average. Weighted average assets beta or beta assets of the combined. Okay, which is BAC, beta asset of the combined. The beta asset of the combined will be computed as the beta asset of EP, okay, multiplied by the total market value of equity and debt of EP divided by the total market value of equity and debt of EP and BO on one side, plus, open a bracket, the beta assets of BO multiplied by total market value of equity and debt of BO, all divided by total market value of equity and debt of EP and BO. So we have done this previously. Therefore, I will then say beta asset of the combined. I will go to the question. I want to determine beta assets of the combined. So the beta asset of EP, we are given 0.9. That's the beta asset, 0.9. So here will be 0.9 multiplied by total market value of EP. The market value of EP is 1690. Okay. The essence of that step 3 is for you to be able to solve for step 4. That's why you are calculating, because you are using the market value as the proportion. So here is 1690 divided by 8490 plus, open a bracket, 1.2 multiplied by 2400 divided by 8490. That's it. So bring out your calculator. 1690 divided by 8490 equal, multiply by 0.9 equal, that's 0.65. So here is 0.65 plus the other side, which is 2400 divided by 8490 equal, multiply by 1.2 equal, that's 0.34, 0.34. When you add the two together, that's 0.99. So this is the beta asset of the combined. So that's step 4. We then move to step 5. Step 5 says you should regear to incorporate financial risk after the business combination. So step 5, regear. Okay, you regear to incorporate the financial risk after the business combination. Okay, so in this case, I want to regear. I would then say beta equity of a gear equal. The formula I'm going to use will depend on whether I'm given debt beta or maybe debt beta is risk-free. According to the question, we don't have anything like debt beta. Therefore, it is assumed that debt beta is risk-free. So if that is the case, then the beta equity of a gear would then be equal to the beta asset of the combined we have computed in step 4 multiplied by 1 plus 1 minus tax, debt equity proportion after the business combination. From step 4 to step 7, it has to be information after the business combination. From step 1 to step 4, it is the information before the business combination. So watch out for that. So the beta equity of a gear would then be equal to 0.99 multiplied by 1 plus, go back to the question, what's the company tax rate? We are told that tax rate, the income tax rate is 20%. So if tax rate is 20%, then we are supposed to account for 80%. So 0.80 multiplied by the debt equity proportion. Debt is 40, equity is 60 after the business combination. So 40 over 60. Mathematically, so this will then be equal to 40 over 60 multiplied by 0.8 plus 1 multiplied by 0.99. Okay, 0.99 equal, that's 1.52. Here is 1.52. That is a gear beta. Then step 6. Step 6 says we should calculate cost of equity. Okay, capping cost of equity. So capping KE equal to risk-free rate of return plus beta into market return minus the risk-free rate of return. So equal, according to the question, risk-free rate of return is 2% plus beta of 1.52 we computed. Market risk premium, according to the question, there's a place dimension risk premium. Okay. The risk rate
7%.
of 7%. Yes. So you are told that risk rate of return is a 2% and the market risk premium is a 7%. Thank you. So the difference between market return and risk rate of return is 7. So I would then say 1.52, 7 multiplied by 1.52 plus 2 equal to 12.64. Here is 12.64%. So that represents the cost of equity using capping. Finally, we need to calculate WACOB. Number 7, calculate WACOB. That's WAC. So WAC is computed as equity value divided by equity plus debt, cost of equity plus debt value, equity plus debt, after tax, cost of debt. Okay. So WAC equal to the debt equity proportion given to us after the business combination in market value terms is 40 to 60. So equity is 60, that's 0.6, multiplied by cost of equity of 12.64% on one side plus the other side. Value of debt, the debt equity proportion is 40%. So 0.40 multiplied by cost of debt, we are told in the question is 4.55%. After tax cost of debt, 0.80. Okay. Mathematically, multiply by 0.6 equal, that's 7.58. Here is 7.58%. Plus the other side, which is 0.4 multiplied by 4.55 multiplied by 0.8 equal 1.46. So add the two together. Okay. So 7.58 plus 1.46 equal, that's 9.04. 9.04% is the WACOB. Approximately, that's 9%. Okay. WACOB is approximately 9%. So now that we have the cost of capital to be 9%, we can then proceed with the calculation of the market value. You can see we stopped for about 15 minutes ago because of the WACOB. So because we cannot proceed because of the fact that we don't know the cost of capital to use. So now that we have it, we can then discount. Equal, that's 0.917. Okay. 0.917. Let me rewrite it. 917 for year 2. 1.09 raised to power 2 minus, that's 0.842. Year 3, 1.09 raised to power 3 minus, that's 0.772. Year 4, 1.09 raised to power 4 minus, that's 0.708. So with this, I need to get the present value. That's what we are looking for. Present value is the same thing as market value. Therefore, 1234 multiplied by 0.917. 7, that's 1132. 1291 multiplied by 0.842 equal 1087. 1350 multiplied by 0.772. 1042. 1413 multiplied by 0.708. That's 1000. So that's the present value for the first 4 years. So PV of year 1 to 4. Okay. Figures in million. PV of year 1 to 4 will then be equal to 1132 plus 1087 plus 2042 equal 4261. Here is 4261. This is the present value for the initial phase for the first 4 years. So we need to calculate PV of year 5 to infinity. You know, business is a business will operate for the foreseeable future. So you have done for the initial phase, which is for the first 4 years. So you also need to calculate the value of the business to infinity. Therefore, to do this, you are going to pick the free cash flow of the firm of base year. You then go back to the question, if you are given free cash, if you are given growth rates after year 4, we are given growth rate of 2.25. So 1 plus G divided by the WACC. WACC denoted as R, or just use WACC. Okay. Minus the growth rates multiplied by the discount factor of the base year. So with this, the free cash flow of the base year, ordinarily the free cash flow of the base year is supposed to be 1413, but we cannot use 1413 because the examiner has told us that the synergy, there will be no synergy after year 4. So since there will be no synergy after year 4, the free cash flow of the firm in year 4 is what we are going to use, which is 1313. So here is 1313 multiplied by 1.0225. The growth rate is 2.25. So divided by, divided by, let me write that.
Why do we put DF? If free cash flow of base year, I'm just wondering why is it D there?
Why is what? Which one?
No, I'm just curious. The free cash flow of the base year.
Yeah.
No, we say D. I'm just wondering what that D represents.
There's no D, there is B. B is base year.
No, yeah.
Free cash, this one, is it this one you are talking about?
The other one.
Discount factor of the base year.
Okay, it's fine. It's fine, please.
All right. So the WACC we computed is 9%, 0.09 minus 0.0225. Discount factor of the base year is 0.708. 0.708. So what do you have here? So using your calculator, this is 1.0225 multiplied by 1313 equal divided by, open a brackets, 0.09 minus 0.0225 close the brackets, equal, then multiply by 0.708 equal, that's 14,081. Here is 14,081. Add it up. Okay, add it up. So this will then be plus 14,802 rather. So plus 4261 equal, that's 18,343. Here is 18,343. This represents the total present value of the combined businesses. That's the market value of the combined businesses. So this 18,343 represents the corporate value. Remember, this is not what the examiner asks you to do. You have to calculate additional equity value created, but you can't just go ahead and calculate additional equity value without following these procedures. So the next thing we need to calculate now is to get the equity value. So I would then say equity value, equity, call it post-acquisition equity value. Figures in millions. Okay. So to get the post-acquisition equity value, you pick the corporate value. The corporate value is the post-acquisition. Let me do it this way. So post-acquisition market value, which is the corporate value. The corporate value is 18,343. Then you less the debt value. We are told, according to the question, that debt is 40%, but debt equity proportion is 40 to 60. So debt is 40% of the corporate value, 343. So what do you have there? Multiply by 0.4 equal, that's 7,337. Here is 7,337. So the difference will give us post-acquisition equity value, which is minus 18,343. That's 11,006. So the post-acquisition equity value is 11,006. So number 3. Now we can answer the question as required. So examiner is asking you to estimate the additional equity value created. So I would then say additional equity value created. Okay. So the additional equity value created is the difference between the post-acquisition equity value and the pre-acquisition equity value of the combined businesses. Okay, of the combined companies. So this is shown as follows. Okay. Figures in million. So I'll pick the post, which is the corporate value. So corporate value, so what am I saying? The post acquisition equity value is 11,006. Then the pre-acquisition equity value is 8490. The difference of 8490. The difference of 2516 represent the additional equity value created. Okay, that's that. So we just answered requirement number A. Let's go to requirement number B. Let me know if you have any question before we move to requirement number B. Any questions so far? Okay, so let's continue. Requirement number B, you are to estimate the impact of EP's PLC equity holders if premium paid is increased to 50% from 30%. You will notice that from the scenario in the question, examiner told you that EPPLC has offered to acquire BOPLC through a mixed offer of one of its shares for 2 BOPLC shares, that is 1 for 2, 50% of the share capital of a BO, plus a cash payment such that a 30% premium is paid for the acquisition. Shareholders of BOPLC feel that a 50% premium will be more acceptable. EPPLC has sufficient cash reserves if the premium is 30%, but not if it is 50%. So what examiner is saying here is that EP has the capacity to pay premium on the market value of BO, okay? But the shareholders of BO is requesting for 50%. The management of EP has capacity for 30%. So examiner is now asking you to determine the impact of EPPLC equity holders if premium paid is increased to 50% from 30%. So if you go beyond your capacity, that may result to losses. So examiner is now asking you for the additional premium that EP will pay, okay, will pay to the shareholders of BO PLC. So to do this, that's number B, requirement number B. Okay, impacts. To get the impacts, you need to first of all determine the additional premium paid. Once you get the additional premium paid, then you also need to calculate the post-acquisition market value, post-acquisition number of shares. The post-acquisition number of shares will represent the number of shares of EP, 100%, plus the number of shares acquired in BO. So you add the two together, that will give you the post-acquisition number of shares. So first thing first, you need to get the premium loss. Okay, premium loss, because the company EP has capacity to pay only 30%. Now you are increasing it to 50%. So the additional premium paid will represent a loss. Okay, figures in million. So you can save 50% premium. if 50% premium is paid, that is 50% multiplied by the value. The company BO is worth 2.4 billion, 2,400. That's the worth of BO. So which is 1,200, but EP has only 30% capacity premium to pay. Has capacity to pay only 30% premium of the value of BO, which is 480. Is it 480 or 720? That should be 720. 24 multiplied by 0.3. That's 720. So the difference is 480. So this represents the extra premium paid. This extra premium is a loss. Okay, that's a loss. So examiner is now asking you to calculate the impact, to determine the impact of this additional premium paid on the shareholders. So since examiner is referring to shareholders, then you need to calculate the number of shares after the acquisition. So to determine the impact of the additional premium or extra premium on the equity holders of EPPLC. The most important thing to do is to calculate the post-acquisition number of shares of the combined, okay, and divide the extra premium paid with the post-acquisition number of shares. Okay, so to do this, I would then say, first thing first, I need to calculate the post-acquisition number of shares. So post-acquisition number of shares will be equal to number of shares of EP plus number of shares acquired in BO. Number of shares in EP is 210 million, plus we are told that EP will acquire 50% of the share capital of BO, okay? So EP has offered to acquire BO PLC through a mixed offer of one of its shares for 2 BO PLC. That's it, 1 for 2, that's 50%. So 1/2 multiplied by the total share capital or total number of shares in BO is 200 million. So here will be equal to 210 plus 100 million shares. Okay. So here is equal to 310 million. 310 million shares. Okay. So if that is the case, I've determined the post-acquisition number of shares. Since the post-acquisition number of shares admitted is determined, then the impact now, impact will then be equal to a premium loss. Call it premium loss. Premium loss per share will then be equal to total extra premium paid divided by post acquisition number of shares, which is equal to 480 million naira divided by 310 million shares. So what do you have here? 480 divided by 310 equal, that's 1.55. 1.55. This means that if, I can then say, if premium paid is increased from 30% to 50%, the equity holders in EP PLC will lose 1 naira 55 kobo per share. If you like, you can get the percentage, or that is 1.55 divided by the share price in the current share price of EP is 29 naira. So 29. If you want to get the loss per share in percentage, so that would then be 1.55 divided by 29 naira. That's 0 points multiplied by 100%. That's about 5.3%. Okay. That's it. That answers requirement number B. That's what examiner wants you to do. 5 marks. Then lastly, number C. You are asked to estimate the additional funds required if a premium of 50% is paid instead of 30%, and discuss how this premium could be financed. This is very straightforward. We've already done it. So additional funds required. Number C, Roman figure 1. Additional funds required. Okay, something we have done. So I don't need to waste much time on this one. So just repeat the calculation you have done for that 480. So additional funds, additional premium will then be equal to 50% minus 30% multiplied by 2,400. That will give us 480. That's the additional funds required. Okay. That's a bonus requirement. However, for the C2, C Roman figure 2, C Roman figure number 2, examiner is asking you to discuss how the premium could be financed. So simply put, how do you finance merger and acquisition? There are three There are three key ways in which you can finance an acquisition. Okay, methods of financing. Method of financing the premium. So there are basically three methods of financing, and each of them has its own advantages and disadvantages. Number one method is through share exchange. Okay, you can finance the 480 million naira through share exchange. That is, you issue additional shares. Then number two, it can be financed through cash payments. Okay, cash exchange. Then number three can be financed through debt. You borrow and finance it. So these are the three methods of financing the premium. The first one, the issue of shares, maybe convenient for the company because you are just issuing additional shares. So it may be convenient for the company, but issuing additional shares will depress the earning per share of the company, and also impact the shareholders, we dilute shareholders proportionate holding. All right, if you issue shares for this 480, ordinary right now, the number of shares of BO is 210 million. If you now issue additional shares to finance this 480 million additional premium, so a shareholder that is having a 10,000 shares before, okay, a shareholder that is having a 10,000, maybe a 10% shareholding before, that shareholding will be depressed, okay, will be diluted as a result of issuing additional shares because the share base has increased, but the earnings remain the same. So the proportionate holding of the shareholders will reduce, okay, as a result of issuing additional shares. So that's one. Then number two, through cash payments. Cash payments may also be convenient, okay, if the company has the means, if the cash is available. However, the cash payment financing this premium through cash payments will depress or will dilute the earning per share because it is through the earnings that you are going to pay the cash. So, meaning that the denominator, which is the number of shares, will remain the same, but the numerator is the profit after tax, or your earnings will reduce. So if your earnings reduce, but your number of shares remain the same, so the earning per share will be depressed. So if cash payment is paid to finance, or if this additional premium is financed through cash payment, it will dilute the earning per share. Okay. Then the last one is debt. Debt is a cheaper source of financing because of tax deductibility benefits. However, financing the premium through debt may dilute the ownership structure of the business or of the company. Okay, it may dilute the ownership control of the business, because if the company fails to pay the debt in the future, the debt holders may take over the company, or they may become part owners of the business, which will the current owners of the business may lose control. So if you pay through debt, it will result to dilution of control or ownership. So these are the things examiner wants you to do. And that's the end of the question. Let me know if you have any question for me so that we can go to another area. We have spent over an hour on this. Okay. So if there's no further question, let's stop. I will stop sharing, then move to another scenario. Okay. Let me see. Let's look for another scenario. So let's solve this illustration number 4. Please, I need one of you to read for us illustration number 4. Who will help us to read? Yes,
Okay, I'm reading.
thank you.
The directors of Arsenal PLC are considering the acquisition of Lacazette Limited, an unquoted company. The shareholders of Lacazette Limited are willing to sell the business on 1st January 2011 for 500 million. From the perspective of the directors of Arsenal PLC, the projections of the performance of Lacazette Limited are shown below. All figure assumes correct. The assumed company tax rate is 35% per annum. The terminal value of the investment is treated as a constant perpetuity equal to the free cash flows for the year 2016. The risk-free rate of interest is assumed to be 6% per annum. The return on market portfolio is taken to be 13.5%. Waste and asset beta of 1.1 is used for purposes of the evaluation. Annual capital expenditure from 2010 onwards is estimated at 20 million each indefinitely. Lacazette Limited currently has an issue 400 million of 8% debt, and it is intended that all available cash flows should be applied to repaying these debts at the earliest opportunity. Required, advise the directors of Arsenal PLC whether to proceed with this acquisition.
Thank you, Jude. That is the question. So examiner is asking of Arsenal PLC whether to proceed with the acquisition. The director of Arsenal PLC will only proceed with the acquisition if it will result to additional value being created. Okay, so if additional benefits will accrue to Arsenal PLC, then the directors of Arsenal PLC can go ahead with the acquisition of Lacazette. However, what are you supposed to do in getting additional equity value created? The first thing first is for you to calculate the free cash flow. Okay, you calculate the free cash flow, then you now discount the free cash flow using the appropriate cost of capital. But first thing first, once you get the free cash flow, you need to ascertain which scenario is this one. Is this scenario 1 or scenario 2 or scenario 3? So in this question, in the first paragraph, examiner has told you that the shareholders of Lacazette PLC are willing to, the shareholders of Lacazette Limited are willing to sell the business on 1st January for 500 million. That 500 million is the purchase consideration. Okay, that's the purchase consideration. However, to ascertain whether business rate will change, in the first paragraph, there is no indication to show that Arsenal PLC and then Lacazette Limited are in the same industry. So we don't know whether business rate will change or not based on the paragraph information. But in the second paragraph, examiner has told you that the risk-free rate of interest is assumed to be 6% per annum. The return on market portfolio is taken to be 13.5%, whilst an asset beta of 1.1 is used for the purpose of the evaluation. So examiner has given to you only one asset beta, which is 1.1. So since it is only one asset beta that is given to you, it means that both Arsenal PLC and Lacazette Limited, they are in the same industry because you are given only one asset beta. So that means business risk will not change as a result of this business combination. Then in the second paragraph, after the table, you are told that annual capital expenditure from 2010 onward is estimated at 20 million naira each indefinitely. Lakaseti Limited currently has on issue 400 million naira of 8% debt. Okay, so Lakaseti has 400 million naira 8% debt, and it is intended that all available cash flows should be applied to repaying this debt. So as a result of Arsenal acquiring Lakaseti, Arsenal is going to pay debt of 400 million naira. So which means that the financial risk of Arsenal PLC will change with this 400 million naira, by this 400 million naira. So as far as the scenario is concerned, business risk is not changing, financial risk will change. Therefore, you are supposed to appraise this business combination by discounting the cash flows using the adjusted present value. So you evaluate the business combination using adjusted present value. So using adjusted present value, you know the procedure. There are three key procedures. The first procedure is to calculate base case NPV. Then step 2, you calculate present value of financing effect cash flow. Then step 3, you calculate APV. APV is the corporate value, which is represent the total market value of the combined. So this is what you need to do. So quickly, without wasting time on this, let's stop sharing and then move to the working notes. Okay. All right. Illustration number, can this one occupy? Illustration number, what is that? Number 4, thank you. So illustration number 4. Arsenal PLC is the predator. So what am I supposed to do? First thing first, I will say business risk is not changing since both Arsenal PLC and Lakaseti Limited have the same asset beta of 1.1. Okay. Then financial risk will change since Arsenal PLC is expected to pay a debt of 400 million naira as a result or resulting from the acquisition of Lakaseti. Okay. Therefore, business risk will not change only because of time. Therefore, the valuation will be carried out using the adjusted present value. That's it. So using adjusted present value, the first thing I need to do is to calculate base case NPV. And in calculating base case NPV, okay, so I will calculate base case NPV. Step 2, I will calculate PV of financing effects. Then step 3, I'll calculate adjusted present value. Things to do. Calculate. Okay. All right. So let's calculate base case NPV. Number 1, calculating base case NPV. The figures given in the question are in million. So figures are in million. But I'm supposed to start from the next page. This page cannot accommodate. So calculating base case NPV. So in calculating base case NPV, first thing first, I need to know how many years we are given from projection. We are less concerned with the current year value. So remember, cash flow must relate to the future. It's the future cash flow that you need. So projection during the planning horizons in years. So from 2011 to 2016, that's 6 years. Therefore, I'll say year 1, year 1, year 2, year 3. Let me give space. Year 1, 2, 3, 4, 5, and then year 6. So I want to, first thing first, when you want to calculate your base case NPV, you need to calculate the free cash flow. So I would then say free cash flow. So according to the question, the free cash flow of Lacazette in the first year, you are given profit before interest and tax. Had it been we have profit after tax, would have started from profit after tax. But since you only have profit before interest and tax, so we start from profit before interest and tax. Okay, so we want to calculate free cash flow. I would then say profits before interest and tax. In 2011, profit before interest and tax is 97, rounding. So here is 97. In 2012 is 119, 119. In 2013 is 143, 170, 143, 170, then 200, 200. So that's the profit before interest and tax. The next thing we need to do after profit before interest, remember we are calculating free cash flow. So after profit before interest and tax, you need to pay tax. Tax. What's the tax rate? Tax rate, according to the question, we are told is 35%. So what's 35% of 97? So 97 multiplied by 0.35 equal, that's 34, rounding. Be giving me the number so that it will be faster. 119 multiplied by 0.35, that's 42. 143 multiplied by 0.35, 50. 170 multiplied by 0.35, that's 60. You say what?
70.
No, correct.
Here will be 70.
70.
Here will also be 70. So that represents the tax liability. Then after tax, we are going to add back the non-cash item. So I will go back to the question, if you have anything like non-cash items. So we have depreciation and amortization. Depreciation and amortization. So add it back. So depreciation is 42, 44, 46. Add it back, 42, 44, 46, 48,
40, 50.
50, then 52. Then after depreciation, you consider changes in working capital. I will then go to the question if you have anything like working capital. So according to the question, we don't have working capital, therefore you ignore. Then after working capital, you need to consider capital expenditure, whether the company will incur future non-current assets. So we are told that in the last paragraph, examiner mentioned that annual capital expenditure from 2010 onward is estimated at 20 million naira each indefinitely. So we have capital expenditure of 20 million naira. So I would then say capital expenditure 20 million. It's a cash outflow. Okay. 20 million. 20 million. 20 million. After capital expenditure, so there's nothing you want to do again, just find the free cash flow. Therefore, 97 minus 34 plus 22. Okay, that's 85. The next one,
101.
101. Okay. The next one,
119.
109.
No, 119. 119.
119. Okay. One,
138.
119. So year 4 is what?
No, year 5 is 160.
138. Year 5 is
160.
160.
No,
Then
5.
Year 5. Okay, 160. Then here will be 162. Okay. So this represents the free cash flow. So now that we have calculated the free cash flow, the next thing I need to do, for me to get the base case NPV, I need to discount the free cash flow using the cost of equity on gear. All right, I need to calculate cost of equity on gear. Remember, in my explanation, to get the cost of equity on gear, there are 3 ways depending on the information given. If you are given beta, then you need to identify the beta, you ungear the beta. If it is geared, then you calculate cost of equity, capping. That's one. If you are given cost of equity, then you are supposed to calculate cost of equity on gear using Miller and Modigliani formula. So if you are given WACC, you go ahead and calculate WACC of on gear. So that's what you need to do. In this question, we are given a beta. Examiner has given us a beta of 1.1. So we need to use that beta to, this is 1, 2, then 3. Let's use this one as our workings. So working number 1. According to the question, we are given a beta of 1.1. So in that case, I will say beta, and it is asset beta for that matter. So we are given asset beta of 1.1. So that asset beta is already on gear. So there's no need for you. You are going to skip step 2. So you skip step 2. Or let me just put it there on gear. So no need to gear since asset beta is given. Then step 3, you calculate capping. So capping equal to risk-free rate plus beta, market return minus risk-free rate of return. So according to the question, risk-free rate of return is 6% per annum. The return on market portfolio is taken to be 13.5%. So here is 6 plus beta of 1.1. Market return is 13.5 minus 6 risk-free rates. So cost of equity will then be equal to 13.5 minus 6 multiplied by 1.1 plus
14.3.
14.3. I did not even get the right answer, Seth. Let me do it again. There's a mistake. 13.5 minus 6 equal, okay, multiply by 1.1 equal plus 6. That's 14.25. 14.25 or 14.3% is the cost of equity on geared. Now that I have the cost of equity on geared, I can then proceed to calculate the to discount the cash flow. Okay, so let's go up there. At 14.25%. So 1.1425 raised to power 1 minus equal 0.875. 0.875. Year 2, 1.1425 raised to power 2 minus 0.77766. 1.1425 raised to power 3 minus equal 671. The next one, 1.1425 raised to power 4 minus, that's 0.587. So that's number 0.587. Yeah, 4 supposed to be, oh, sorry. Here is 0.587, 0.587. Then year 5, 1.425 raised to power 5 minus 0.514. Then finally, 1.425 raised to power 6 minus, that's 4.450. So you get the present value. Give me the present value for each year, please. Multiply. 85 multiplied by 0.875. 74. 101 multiplied by 0.766.
77.
77.
79, 80.
80.
81.
81.
82.
82,
73.
73. So we add up all the PVs. So 74 plus 74 plus 77 plus 161 plus 155. That's 467. So the PV of year 1 to 5 is 467. So we need to calculate the present value to infinity. Year 7 to infinity. So PV of year 7 to infinity will then be equal to free cash flow of the base year. There is no growth rate after year 6 because examiner has told you that in the second to the last paragraph, you are told that the terminal value of investment is treated as a constant perpetuity equal to the free cash flow for the year 2016, okay? So the year 2016 is the base year. So, and we are told that the free cash flow is constant, all right? So if that is the case, there is no growth rate. Therefore, divided by the cost of equity on gear that we have computed, multiplied by the discount factor of the base year. So free cash flow of base year is 162 divided by 0.1425 multiplied by discount factor of the base year 1.450. So what do you have here? So this will be equal to 162 divided by 0.1425 equal multiply by 0.45 equal, that's 512, 512 is the market value from year 7 to infinity. So the total market value will then be equal to 467 plus 512 equal 979. This 979 represents the total present value, which is the corporate value. So, sorry, that's total present value. At this point, we need to get the base case NPV. So the base case NPV will then be equal to total present value minus purchase consideration. The purchase consideration is just like initial outlay. That's the amount the company will pay to acquire Lacassetti. So 979 minus purchase consideration, we are told that the company will pay 500 million. Yes, the shareholders of Lacassetti are willing to sell the business on 1st January 2011 for 500 million naira. So 500 million is the purchase consideration. So the difference is 479 million naira. So that represents the base case NPV. Now that I have the base case NPV, I need to move to step 2, which is to calculate PV of financing. Okay, PV of financing effects. Okay. According to this question, this is very straightforward. We don't have issue cost. There's no subsidized loan, but we have interest. So we need to calculate the PV of tax saved. PV of tax saved on interest. So tax saved on interest. That's what we need to calculate. To do this, I will create a column because in the question, examiner has given us different different interest expense from 2011 up to 2015. So in that case, So create a column for year. After that, create a column for interest. Discount factor. Remember, when we had adjusted present value, I mentioned to you that you can either discount the cash flow arising from the financing effects using the borrowing rates or normal borrowing rates, or you use the risk-free rate of return. So, and I also advise you to always use the cost of borrowing, because cost of borrowing will always be higher than the risk-free rate of return. So according to this question, the cost of borrowing is 8%, because 400 million debts at 8%. So that 8% is the cost of borrowing. So at 8%, then you are going to get, then calculate the tax saved. Tax saved. You get the tax saved, then the PV of the tax saved. Okay. Before this is wrong. So tax saved supposed to come first. Tax saved. The company tax rate is 35%. So tax saved at 35%. Then you have discount factor at 8%. Then you have the present value. Okay. Of course, figures are in million. So give me the interest from year 1 to year 5. Give me the interest, please. 32, 27. 32, 27.
20.
19.
20. 20.
20, 12.
1.3.
20, 12, then 1.3. So 35% of 32.35 multiplied by 32 equal 11, rounding. Again, 27 multiplied by 0.35. That's 9. Then this will be 7. Is it 7? 20
Yes.
multiplied by 0.35. That's 7. Then 12 multiplied by 0.35. That's 4. Then 1.3 multiplied by 0.35. That's 0.5. So I need to get discount factor for year 1 at 8%. So 1.08 raised to power 1 minus equal, that's 0.926. Next one, 1.08 raised to power 2 minus, that's 0.857. Okay. The next one, 1.08 raised to power 3 minus 0.794. Next one, 1.08 raised to power 4 minus 0.736, 735.
Last one, 0.681.
0.681. So we then multiply. Okay. So we multiply. That's 11 multiplied by 0.926 equal 10. 9 multiplied by 0.857 equal 8. 7 multiplied by 0.794, 6. Then 4 multiplied by 0.7,
3.
that's 3. Then 5.5 multiplied by 0.681, that's 0.3. So when you add it up, that will give you 27.3. 27.3, that's the total present value of financing. So now that we have gotten the present value of financing, I will then move to step 3, which is to calculate APV. So if you have issue cost, you have subsidized loan, you still follow the normal procedure. You do all those ones as you normally do. Okay? Then APV now. APV will then be equal to base case NPV plus minus PV of financing. Okay? Base case, we got 479 is the base case. 479 plus 27. So what do we have here? This is 506, I think. Let me use calculator. 479 plus 27. That's 506 million. This 506 million represent the corporate value. So APV, which is corporate value, is equal to 506 million. So examiner is now asking you to advise the directors of Arsenal PLC whether to proceed with the acquisition. So I would then say the directors of Arsenal PLC, the directors of Arsenal PLC will proceed with the acquisition of Lacassette if it will result in additional equity value being created. Okay. So with this, we need to calculate additional equity value. So I would then say equity value will be equal to corporate value. Corporate value is the same thing as APV minus the debt value. Corporate value minus the debt value, which is equal to 506 million minus, we are told that there's a debt of 400 million naira. Okay. Therefore, the additional equity value being created is 106 million. Hence, the directors of Arsenal PLC should proceed with the acquisition. The directors of Arsenal PLC should proceed with the acquisition. Since additional equity value of 106 million naira will be created. Okay. That's it. That's the end of the question. That's the end of the question. So let's have the last scenario. In this case, because the last scenario is also very big and strenuous. So I will use a worked solution to explain it so that we can complete in due time. Let's see. Okay. Is there any question? Do you have any question on this before I switch? We are moving to scenario number 3, where business and financial risk will remain constant. Okay. All right, let me switch. Let me use the golden book to explain it. Again, so it's not sufficient for you to just, you have to state whatever assumption you have made, even though the examiner did not ask you, you have to state all relevant assumptions in the question. Whatever the assumption you have made, you have to state it in all the calculations you have done in the evaluation. You just have to state your assumption for you to be able to earn your full marks. Okay? All right. So let's have illustration. Let's have this illustration, which should be the last areas that we are going to touch. Question on illustration number 6 in the material. That's question on Pantone and Julian. Question on Pantone and Julian. Okay. So, yeah, somebody should read for us, please. I need somebody to read. Yes. Who is helping us?
Okay. Panto PLC
Thank you,
will
Jude.
soon, Panto PLC will soon announce the takeover bid for Julian PLC, a company in the same industry. The initial bid will be an all-share bid of 4 Panto shares for every 5 Julian PLC shares. The most recent annual data relating to the two companies are shown below. All figures are zoomed correct. Okay. The takeover is expected to result in cost saving in advertising and distribution, reducing the operating costs, including depreciation of Panto from 76% of sales to 70% of sales. The growth rate of the combined company is expected to be 6% per year for 4 years and 5% per year thereafter. RT's debt obligation will be taken over by Panto. The corporate tax rate is expected to remain at 30%. Sales and cost relevant to the decision may be assumed to be in cash terms. Estimate how much synergy is expected to be created from the takeover using free cash flow to the firm analysis for each individual company and the potential combined company. State clearly any assumptions that you make. Note the weighted average cost of capital of the combined company is assumed to be 9%. B, discuss any 5 limitations of the above estimates. Explain generally 3 advantages and 2 disadvantages of expansion through merger and acquisition rather than through organic growth.
Thank you, Jide. That is the question. So examiner is asking you to estimate how much synergy is expected to be created from the takeover using the free cash flow to the firm analysis for each individual company and the potential combined companies. So in this number A requirements, what you are supposed to do, you are going to create about 3 different tables. Value for Panto using one table. We also calculate another market value for Julian. Then you now calculate another market value for the combined. However, in each of the cases, you are expected to calculate free cash flow to the firm. You calculate free cash flow to the firm for Panto. You do the same thing for Julian. Then you now discount the free cash flow using the appropriate cost of capital. But first thing first, you need to go back to the question and ascertain what is the scenario. Is this scenario 1, 2, or 3? So first thing first, let us identify the scenario. So when you look at the first paragraph of the question, examiner has told you that Panto PLC will soon announce a takeover bid for Julian PLC, a company in the same industry. Since they're in the same industry, it means their business traits will not change. Okay. Then let's go and identify whether financial risk will also change. So even though you are given debt equity proportion of each individual company, that is not what we are looking for. We are looking for, in case you are given debt equity proportion after the business combination, after the takeover. But let's go to where we have information after the takeover. You are told that the takeover is expected to result in cost saving in advertising and distribution, reducing operating costs, including depreciation of Panto PLC from 76 to 70% of sales. The growth rate of the combined company is expected to be 6% per year for 4 years and 5% per year thereafter. Julian's debt obligation will be taken over by Panto. Okay, so you are taking over debt does not mean that you are paying it. And even at that, the value of the debt is not given in the question. So we don't know the value of the debt. So the fact that you are taking over debt does not mean that you are going to pay for the debt. Therefore, business risk is not changing. Financial risk is also not changing as a result of taking over of Julian PLC by Panto PLC. So which means this is scenario number 3. If it's scenario number 3, what you need to do is to calculate the market value of the business. Okay, how do you calculate the market value? You calculate free cash flow, then you now discount the free cash flow using the current WACC. Okay, using the same way you normally calculate WACC, calculate cost of equity, calculate cost of debt, then you go and calculate WACC. So it's the same thing. That's basically what you need to do. So to solve this question, like I said, look at my explanation here. Consistent with the scenario in this question, business risk is not changing because Panto PLC and Julian PLC are in the same industry. Okay. The financial risk is also not changing because we are not told that the company will pay debt or borrow funds to finance the takeover. All right. Then, hence, since business and financial risks are not changing, the free cash flow should be discounted at the current WACC of the combined company for the determination of this expected synergy. Now, to get the free cash flow, to calculate the market value, you have to do to calculate market value for the for individual company. That will represent the pre-acquisition market value of Julian, pre-acquisition market value of Panto. Then you now calculate the post-acquisition market value of the combined. That's all you need to do. Of course, you have to state all relevant assumptions as stated in the question. So first thing first, we need to calculate the market value of Panto. So for me to be able to calculate the market value of Panto, I need to first of all calculate the free cash flow of Panto. I will then go back to the question, how do I calculate my free cash flow? In this question, I can see profit after tax. Here is profit after tax. Ordinarily, if there were to be no adjustments, I would just use profit after tax to calculate my free cash flow to the firm. But because examiner has told us that sales will increase, there will be growth in sales value, there will be growth in operating costs. Okay, so what that simply means is that I cannot use profit after tax to compute my to calculate my free cash flow. So I have to start from the beginning. So starting from the beginning, I will create a column. Of course, the normal way, I want to, the sales value of Panto is 13,333. That is the sales value of Panto. I will then go back to the question, what's the growth rate of the cash flows? Examiner has told you in this question that you are told here that the expected annual growth rate in sales, operating costs, including depreciation, replacements, investment, and dividend for next 4 years is 4% for Panto. So what that means is that the revenue of Panto will grow by 4%. So you carry your calculator, 1.05 multiplied by 13,333. So when you do that, then we are going to have 14,000. That's the 14,000 you are seeing here. Okay, let's go and check our workings so that we follow through. Okay, so this is the 14,000. This is how we do it. I use the primary school method here. All right, so that's the 13,000 for revenue. You grow it by 5% because the 13,000 is in current value times. So we got this. So this is how we calculate. You're already familiar with all this procedure. This is how we build the sales value, sales revenue. So since we have the sales revenue for Panto, then of course we have to post it. All right, that's how we post all these numbers. Then operating costs. According to the question, operating costs for Panto is 8,683. An examiner has told you that this operating cost will include depreciation. So depreciation for Panto is 1,600. So 1,600 plus 8,683, that should give you 10,000 something something. So let's go and check it. Okay. Yeah. So 8683 plus 1450 will give us 10,133. So when you grow that by 5% inflation rate, so that will give you 10,640 for year 1, 11,172 for year 2, 11,730 for year 3, then 12,317 for year 4. That's the operating cost. So that's how we got the operating cost. You less operating cost from the sales revenue to get the operating profit. Immediately after profit, you are supposed to pay tax. So 30% of 3,360 is this 1,008. 30% of 3,528 is 1,058. 30% of 3,705 is 1,112. 30% of 3,889 is 1,167. So I don't need to find difference to say, okay, profit after tax, just ignore. So I will then go back to the question if I have depreciation. So examiner has given us depreciation. So depreciation is 1,450. So when you grow 1,450 by 5%, that's what gave us 1,523 for year 1, 1,599 for year 2, 1,679 for year 3, then 1,762 for year 4. Then I will go back to the question. I want to know whether I have changes, whether there will be changes in working capital. Examiner did not give us working capital in the question. Therefore, you ignore working capital. We'll move to the next one, which is capital expenditure. Confirm if there will be additional capital expenditure to be incurred. So examiner has told us in the question that there's investments, there's replacement investments. Okay, so we are given annual replacement capital expenditure to be 1,600. Okay, for Panto. So in that case, you need to grow that by 5%. So 1,600 multiplied by 1.05, that's 1,680. 1,680 multiplied by 1.05, 1,764, 1,852, then 1,945. We find the difference between operating profit and the other variables. So we have for year one, free cash flow is 2195. In year two, free cash flow is 2305. In year three, free cash flow is 2420. Then in year four, 2539. So at this point, we need to go and calculate the weighted average cost of capital of Panto, okay? Because we have identified in the question that business tree will not change, financial risk will also not change. So we are supposed to discount the free cash flow to the firm using the WACC of individual, using the WACC of the combined, but we examiners say we should calculate for individual company before we calculate for the combined. So what is the WACC of Panto? So let's go and calculate WACC of Panto. To get the WACC of Panto, I need to first of all calculate cost of equity. So how do I calculate cost of equity? Examiner has given us information on capping. I can see risk-free rate of return here. Okay, I can see market return. I can see debt, equity beta. I can see equity beta of individual company. So in that case, I'll put it in the capping formula. I will get cost of equity for each of the companies. So let's go and do working for that first. Okay. Yes. So to now get the cost of equity, so for Panto, cost of equity of Panto, of course, you are familiar with the formula of cost of equity. So put it in the formula. Cost of equity of Panto is 12.26. So I will then go and calculate what was the cost of debt. Cost of debt, according to the question, the cost of borrowing for Panto is yes, it's 6%. That's the cost of borrowing. Current market cost before tax or fixed interest debt is 6%. So the cost of borrowing for Panto is 6%. Put it in the formula. You get the that's the cost of debt. Now that we have the cost of debt, we need to go and calculate the WACC of Panto. Okay, you already know the formula for calculating WACC. And at the end of the day, we got 10% as the weighted average cost of capital of Panto. So that 10% is what we are going to use. It's what we are going to use to calculate to discount the free cash flow to the firm. Okay, so and that's why you are seeing the 10% here. So when you do that, of course, the total value from year 1 to 4 is 7,433. Then we need to calculate the present value from year 5 to infinity. Okay, you're already familiar with this formula too. Okay, so the free cash flow to the firm of the base year is 2539. So that's what I'm going to grow, this 2539. You grow it by 4% after year 4, okay? So put it in the formula. The total value from year 5 to infinity is 30,058,000. So when you add it to the present value of year 1 to 4 of 7433, so that will give you the total present value of 37,491. So that is the market value of Panto. You will do the same thing for Julian. Okay, just repeat the same process for Julian. So it's the same thing. And the question is straightforward, apart from the fact that examiner make it too cumbersome. all right? Because you do for individual company, you also do for the combined. So for Julian, we also do the same thing. You go and calculate. For example, for Julian, this is the market value of Julian. From year 1 to 4, we got 7,003. Okay, how do we arrive at 7,003? You see the workings for each of them. Okay, for working for revenue, the same way we inflated for Panto, the same thing you are going to do for Julian as well for each year. All right, so you then go and post. You do the same thing for operating costs. You go and post. All right. Then you do for depreciation, you post. You do so for capital expenditure, you post. So that's how we got all those free cash flow for Julian. That's how we got the free cash flow for Julian, all these free cash flows. All right. Then thereafter, you then need to go and calculate the work of Panto, sorry, of Julian. How do you get the work of Julian? So you calculate cost of equity using capping for Julian. Then you calculate work of Julian as well. That's all you need to do. So this is the cost of equity of Julian. All right. Then this is the work. The work is 9% of Julian. All right. So once you have that ready, then of course you discount the free cash flow of Julian. And at the end of the day, we got the free cash, you got the present value of year 1 to 4 of 7,003. You then calculate the PV from year 5 to infinity, which gave us a 44,362. You had the two together, that's 51,365. So that was the present value from year from year 1 to infinity. That's how we got the value of Julian. So then examiner now told you to calculate the market value of the combined. To do this, you go back to the question. You go back to the question, go and check the scenario after the takeover of Julian. What did the examiner say you should do? Examiner mentioned to you that the takeover is expected to result in cost saving in advertising and distribution. So reducing the operating cost, including depreciation of Panto from 76% of sales to 70% of sales. What this simply means is that you are going to add up the sales value of Panto and the sales value of Julian. You add the two together, then you now multiply 70% of it. You now get 70% of it. That's what you are supposed to do. Then, of course, you now grow it. You grow it by 6% for the first 4 years, then 5% thereafter. So that's what you need to do on that. So quickly, for the combined, yeah. So you add up the revenue of the two companies. So you add up the revenue of the two companies, then you grow it by 6%. That's what we did there. This is the revenue. This is the revenue of Panto plus the revenue of Julian. Add it together, then you grow it by 6%. We got the 24097 for the first year. You go for the second year, the third year, and the fourth year. So you go and post. You do the same thing for depreciation. You add up the depreciation of the two companies. You grow it by 6%. Then you go and post. All right. Before that, you need to consider operating costs. Examiner has told you that operating costs for the combined, you are supposed to take 70% of the sales value. So all the sales value that you have computed, just take 70% of it as the operating cost. That's what you are supposed to do. Okay. Then you do the capital expenditure, add up the capital expenditure of the two companies, grow it by 6%. That's what we did to get the market value of the combined. For the first 4 years, the total market value is 16,731. Then you need to calculate the market value of the combined after year 5. Okay, after year 5, which is year 6 to infinity. In this case, examiner has already told you in the question that you should use 9% as a WACC of the combined business. Examiner says you should use 9%. Let me see that information. Okay. Yes, note, the weighted average cost of capital of the combined company is assumed to be 9%. So you are supposed to use 9% for the combined. So, and that's how we got the total market value after the takeover. So that's basically what you are supposed to do. So the market value for the first four years is 16,731. The market value to infinity is 105. We got the total of 121,941. That's the post-acquisition market value of the combined companies. Okay, so that's that. Then next thing you need to do is to state your assumptions. All relevant assumptions must be stated. However, in the requirement, examiner wants you to calculate synergy created. What is the synergy created? The synergy created is the difference between the post-acquisition market value of the combined and the sum of the pre-acquisition market value of the individual companies. So you are going to add up the present value of Panto and Julian. That will represent the pre-acquisition market value. Then you now less the post-acquisition market value. So the difference of 33,085,000 naira represent the synergy that will be created as a result of taking over Julian by Panto PLC. So that's that. So the next thing you need to do now is to just state all your relevant assumptions. Even the examiner is asking you whether you are asked or not, it is important that you state your assumption. So when you are stating your assumption, you talk about cash flow. What do you mean by cash flow? You already know all of these things. We have done it severally previously. So it is assumed that the cash flow estimates are realistic and will occur at the end of each year. All the relevant cash flow has been inflated at the appropriate growth rates. So that's that. Then you talk about interest. Okay. This has been ignored in the calculation above because it has already been included in the WACC. Okay, that's that. Then you can also talk about cost of capital. We can talk about inflation rates. When you talk about the inflation rates, what it simply means is that it is assumed that the inflation rates will remain constant within the relevant range. Okay, so these are the things that you are supposed to comment on. So that's end of the question. That's end of the question. All right. So I will encourage you to go and try illustration number in the material I share with you. Go and try illustration number 4, I think. The question you have on is it Vicotoni or something? Let me see. Yeah. Illustration number 7, Vicotoni. So I would have loved to solve that question, but that will not permit me. I don't know if you want me to have your additional class on this so that we can just solve that Vicotoni, or you can just, if you have the golden book, just you see the solution there. It's well simplified. It's well simplified. All right. So let me know if you have any question for me, please. Any question for me so that we can close the class for today? Okay. In the absence of no question, today is the last lecture day for this period. And I want to thank every one of you for making us